Well, a warm welcome everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial. Today we have Chad Padowitz from Talaria Asset Management. Chad is the Co-Chief Investment Officer of Talaria Asset Management and has more than 25 years of experience in the financial services industry in the UK, South Africa and Australia. His experience includes work as an analyst in the Treasury Department of HSBC Bank in London, in derivatives reporting and analysis, and as an equities research analyst for the First National Bank in South Africa. Chad co-founded Talaria Asset Management in 2018. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Thanks for joining me today, Chad. It's been 12 months since our last vlog, and a lot's happened in that time frame. We've had the US elections, global trade tensions, and now 3 ongoing conflicts, including Ukraine and 2 in the Middle East. No doubt you'll have some valuable insights to share, particularly from Talaria's perspective. To kick things off, as a fund manager specialising in global equities, can you start by giving us a quick overview of Talaria's history and investment philosophy?
Great, thanks, Joel. Great to be here with you. So very quickly, the fund strategy is actually in our 20th year. We are a global equity fund, concentrated 25 to 40 companies, mid to large cap value side of things. We only do one thing. Effectively, we have a value bottom-up free cash flow type analysis type process with a high level of income as a component of return.
Okay, well, can you elaborate more on the process and how you identify quality businesses globally?
Yeah, so very briefly, we do have an investment team of 7 people, of which I'm one of, and we look monthly. We have a screen and we look at the top decile the top 10% of opportunities across a range of financial metrics, and that's what drives us to spend more time on those potential names. But ultimately, what we're trying to get to is a normalized free cash flow, a sustainable number that we think a business can earn, and then we value that at what we think is an attractive valuation to get to a decision to ultimately look to buy something.
Okay, well, taking that approach, how do you then overlay risk management, especially in a global volatile environment like we're seeing at the moment?
Yeah, so risk management has multiple layers. Effectively, at the very start, just now 20 years ago, from the strategy's inception, which effectively takes about a third of the market risk out. So we're taking around 2/3 of market risk as a strategy. And that's the manner in which we invest in shares. So right at the beginning, we take out about 1/3 of market risk as part of the strategy. The next layer of risk management comes from bottom-up stock selection, which we focus on free cash flow yields. We take out a lot of non-recurring items, a lot of things that actually can impact what the real earnings rate of a business. We focus substantially on balance sheet strength and sustainability. So that goes to the underlying bottom-up risk management. And then ultimately you have on top of all of that portfolio management, where we have, as I mentioned, 25 to 40 companies. So there's a fair level of diversification across stocks and sector as well.
Okay, well, what are some of the key opportunities, and given what's happened over the weekend, the risks we're seeing in the markets at the moment, both locally in Australia and then globally?
Yeah, so look, our focus is on we're a global equity fund, so we just look at things outside of Australia. As I said, we look at things from a normalized basis. We generally have a 3-year average holding period, so we don't tend to jump in and out of stocks, and very short-term market movements sometimes create opportunities, but broadly, we're not looking that short-term. In terms of more recent periods, look, there's no doubt the market's become more concerned about AI from a risk point of view than an opportunity point of view. Now, our screen will look at things that have been potentially impacted, and we'll spend a bit more time on that. But I can say, as of right now, I would say the market is generally broadly quite expensive, and the opportunities are not at the sector or even what's been dislocated by the market, but rather just individual stock opportunities that we see, a bit of insurance, a bit of healthcare, a bit of distribution type businesses, rather than any one broad theme, to be fair, Frank.
Okay. How does Talaria differentiate itself from other fund managers in this space? And what would you say are your greatest strengths?
Look, our biggest single differentiator is, once you take away that we are bottom-up value cash flow led, and there are other people that do that as well, the biggest differentiator that we do is the manner in which we buy shares. And that is every single share we look to own or increase our exposure to begins life actually as a put option that we've sold. And that is effectively generates high level of income and a very big buffer against first loss. So our manner of implementation, which drives high levels of income and downside protection, is our biggest single differentiator versus our peers.
Okay. Can you share an example of a time when the fund experienced a challenging period and then how you guys navigated through it to turn it around and generate a better performance outcome?
Yeah, we've been running this strategy 20 years. So obviously there's been various points where you do better, where you do worse. One of the key things I'll say is we are process led. So even when sometimes that process makes us look smarter than we are, and sometimes it makes us look not as smart, even though we haven't changed what we do. So it's not so much about, it's really about where we've pushed through on the process. And even I've got quite a few examples. I haven't go 20 years, but maybe even a more recent one. So from about April last year till just after do you remember the tariff Liberation Day? The market sold off, but then it really had a phenomenal run up after that on the back of AI excitement and growth excitement and a whole bunch of things around that. Our strategy is broadly not really, we're a value side, so we haven't benefited from growth. And certainly on the AI side, we certainly not, our portfolio is very low in the IT side. So we weren't really participating in that recovery, and our market participation was actually quite lower than our long-term average. Wasn't that we lost money, just we didn't make nearly as much as the market over that 6-7 month period. But in terms of how we navigated, well, we just stuck to our process. We didn't pay up for things that the market got super excited about, and how that's played out now. So that sort of ran up till about, I'm going to say, kind of around late November, December time period. And as we've gone now, the market's now sold off quite a lot of those names, even high quality names like Microsoft and so on, which are down over 15% in the last couple of months. So we stuck to our process. We stuck to cash flow led valuation, and that's now really paid off the last 3-4 months, as that exuberance and euphoria has now effectively reversed itself to somewhat level of fear now, and we're not being on either side of that has actually been very helpful.
Well, talking about fundamental bottom-up analysis, how does your team stay ahead of market trends and maintain conviction in your investment decisions?
Look, we do a tremendous amount of work before stock goes into the portfolio. As I mentioned, we have around a 3-year average holding period. We have 25 to 40 companies. So at any point in time, think of it as a low 30-ish type number. And that 30 type companies, 3-year average holding period, the reality is we're only looking to buy 6, 7, 8 companies, new companies a year across 7 investment people. So we're able and have the time to do a lot of work. When a company comes through the screen and we start working through it, it's about a 4 to 7 week process before we get that level of conviction. So how we stay ahead is we make sure we do the bottom-up work. We understand the drivers, the risks, the hidden small print and things like that, and really then that we overlay that with just a lot of common sense and just practical. We don't chase things. We're not thematic led. We don't let fear or greed excite us. We process led. So all of that discipline via process, via experience, is how we think stay centered.
Okay. Well, Chad, in your view, what makes a great portfolio manager in today's environment?
Well, I think you definitely need to have the ability to not get swayed by short-term price, price tells you nothing. As I think Benjamin Graham once said, there's value in this price. So don't get swayed out. Things are down a lot, it must be cheap, or it's gone up a lot, it must be expensive, or it's gone up a lot, I must buy it. So price is not your friend ever. It can lead you. So that's one thing. I think also being pragmatic and intuitive is underappreciated. Sometimes companies say they're going to grow 20% a year for the next 20 years. And you go, well, they're this big already. If I just do a very quick spreadsheet, does it really make sense they can be that big at that point in time? So there's a lot of extrapolation and compounding that is just simple math that you find often doesn't get done. So a lot of things that you don't need to be the smartest, you don't even have to be the hardest working, frankly. There's a lot of common sense that can add just a lot of value in and of itself. But then when you combine that with patience and process and discipline, I think the combination of that, specifically in a time right now where you've got the funnel of uncertainty being so wide, and you don't really know with AI disruption, with, as you mentioned earlier, geopolitical events and wars, and inflation, are they raising or dropping interest rates? Hard to know at the moment. All of those outcomes are very, very unknown. And that's where those strengths, I think, can really play into your favor.
Okay. Well, Chad, we've covered a fair bit today. Is there anything else you'd like to add before I leave you?
No, I think we have, as you said, covered quite a bit. And it's just been a pleasure to join you.
Well, Chad, I appreciate you making the time to talk with us today.
Thank you.
If you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment.